pleasure to be here with all of you. It's a big honor to be sharing the stage with Stephen Sykes, the COO for Public. Stephen, let's just start with, can you just give a quick introduction on yourself, your background, and about Public?
Sure. So I hope in this audience everyone has heard of Public. If not, Katie's not doing her job. Sorry, Katie can wave to the crowd. She's our VP of Marketing. Anyway, so we're an investing app, retail investing app, focusing on helping people become better investors, right? We do that predominantly in two ways. One, we help build what we call great context for the markets, right? So we build a lot of awesome content, data, and information, including our recently launched product, Alpha, which is sort of a GPT-based chatbot that helps people really do investment research in a fraction of the time. So moments after earnings calls are completed, you can go into Alpha, talk to it about what that company announced, and really have a fulsome conversation as though you're talking to an analyst that had just listened in, which is cool. So one, focused a lot on building content or context. The second thing we focus on is basically giving people access to a broad multi-asset suite of products, right? So I think in contrast to a lot of sort of the more modern retail investment platforms, I think we've made a concerted effort to increase sort of the breadth of products that people can invest in. Everything from, classic equities, crypto, ETFs, but we've quickly expanded into alts and fixed income and are continuing on that pathway.
That sounds awesome. Given your experience in the past in the fintech industry in particular, can you talk a little bit with everybody about what you've seen as how business models have evolved and any sort of fundamental changes you've seen post-pandemic?
That's interesting. I mean, I think when we think about the business model of sort of retail investing, I mean, I think we've been through, I don't know, if we zoom out like 10 years, let's say, to like the early start of fintech, maybe even 15 years, if we go back to sort of, in our category at least, like really what were like the robo-advisors, which were like the first wave of sort of digital wealth management solutions, right? Which sort of fits into the world we're in investing. I mean, I think we started with sort of a product that was launched focused on, making a modern portfolio theory-based product more accessible at much lower cost. Mm-hmm. And I think that sort of carried through into sort of the mid-2000s when we were sort of, when we sort of started, we launched in 2019, when we shifted from sort of focused on sort of that passive approach to investing to a more sort of active approach to investing. I think all with the same sort of through line of helping reduce sort of the barriers to investing and the cost in doing so. So I think a couple of interesting things were like, obviously, the no commission, the no commission wave across sort of the self-directed industry, and then the wave of fractional investing, right? Which, I think no commissions, well past, I think as an industry, we've adopted sort of that idea, very broadly. I think as we think about fractionalization, that has taken hold in the equities space. I don't think we've seen that sort of fractionalization break through in sort of other asset classes, right? And equities is the largest individual retail asset class, but I think, we haven't seen those sort of gains or those sort of technology improvements flow through to things like alts or fixed income, which is something we're working on a lot.
Cool. And, just on that, what you mentioned, fractionalization, and a lot of the products that you offer, whether it's crypto or ETFs and equities and now increasingly fixed income products, those appeal to retail investors. Can you talk a little bit about how you think about retail investors in particular as it relates to Public? And then anything that's unique, you've already talked a little bit about just providing context for investors, but what other services or unique features does your platform have that would appeal to those retails?
Yeah, I mean, so I think I can take both questions in one, which I think the thing I would point to, and one of the things we've learned the most from over the last, call it, year, was the launch of our treasury account, right? Mm-hmm. Which is effectively our attempt to make investing in T-bills and leveraging sort of the benefit of, nearly risk-free fixed income assets available to retail investors as easily as investing in sort of a savings account. Yeah. And I think any of us, that have been in the industry or really have been allocating capital for a long time are familiar with sort of old ways of buying T-bills, high minimums, going through classic, old school brokers, calling somebody to get it done, or even, God forbid, going to like Treasury Direct and dealing with the limited platform that has, right? Like, and I, not to say that really any of us had actually been doing much in the way of T-bills for, call it, the last 15 years, but for those of us that had, it was a pretty bad experience. And then so, if we zoom out 18 months ago from the beginning of sort of the Fed hiking cycle, what we started hearing from our members was demand for access to that asset class and saying, hey, we understand rates are higher than sort of the FDIC insured high yield savings account world, right? Which are naturally going to be a little bit lower because that's how banks make money. And two, there are tax benefits to investing in T-bills that people wanted, especially when they're in New York or California, right? High tax states. And so they came to us and they said, hey, how do we do this? And so we're like, we don't really know. And I don't mean that literally, but I mean 18 months ago, nobody was interested in the fixed income space across the industry, right? Nobody was building. There was not much in the way of infrastructure for actually bringing these sorts of products to a retail investor base. And so, again, we spent a lot of time working through all the potential vendors, all the potential models, and ultimately came up with a model where, hey, we can build this treasury account that has, $100 minimum automatic roll and, make it really easy from a funds flow perspective. And it was really the first of its kind. And seeing retail investors invest in sort of T-bills, which have a different shape as a security than like, a normal stock investment would, right? You buy it at a discount, and then there's an implied yield over the time horizon, and seeing how, and then that yield changes based on the price fluctuation of the underlying T-bill. Like, those are concepts that retail, like, our investors, like, really didn't, it took them a little while to really get it. And it took us a while to iterate through the user interface that, like, could best help them get up that learning curve by doing. And what we've seen on the back end is just like an explosion of interest in the asset class. Again, continued investment in sort of the treasuries, demand for every other fixed income asset classes, right? We've heard demand for corporates, we've heard demand for munis, we've heard demand for longer duration treasury bonds, treasury notes, and we're working hard to sort of meet that demand. But I think we're still a little bit early in the development of our industry and our ability to support or have fundamental infrastructure in the capital market side to be able to support those needs.
Yeah. So this is super interesting because a lot of what you're doing is just educating your client base around these different new products and things. And so as we think about what's happening just generally with the evolution of the broader market, whether that's higher rates for longer or you referenced alternatives, can you talk a little bit about some of the cool things that you're doing? I think it seems like you've gotten into, if you go to the homepage, there's a reference to Shrek royalties and things like that. Can you talk to us about that and how you got into it, how what you're seeing in terms of customer behavior and anything else you want to add that might illuminate what you're doing over there?
Yeah, so I'll tell a little bit of a narrative, right, which I think follows. I think if we like zoomed out and took my last couple of minutes of comments, it's like as an industry serving retail investors, we've seen a shift from the 2020, 2021 speculative go-go years towards again a broader, diversified, more conservative allocation of capital. And I think our alternatives business has followed a very similar trajectory. When we launched that business, we focused on sort of what I would say are genuinely more speculative asset classes, helping people invest in things like, art, right? Which art can be a great asset class, but it's certainly one that, I think we see more heart from retail investors during a more speculative boom time. And what we've seen over the last, 18 months is a shift towards more income generating or cash flowing assets, which is ultimately why we went out and tried this sort of royalty-based stream. And I think we launched, as you alluded to, our first royalties product, which is based on the score of the Shrek movies. So not like the all-star song, but like, we've got the score. And it's a high-yielding, uncorrelated asset that we were able to that honestly our customers oversubscribed in a very short period of time. It far exceeded our expectations, and I think when we can show something that can yield 8.5%, 9% in an uncorrelated fashion, there's a lot of demand. And so I think again, same sort of story as the earlier comments, but I think we're seeing sort of this shift in demand from retail investors to reflect what is a higher for longer macro environment.
Cool. And how are you responding to the shifts in investor demand? Is it more public, thinking about what will appeal to these investors, and then going after that? Is it investors somehow indicating interest? Like, how do you evolve this platform?
Oh, I mean, I guess it's all of it all the time is the answer, right? Like how to figure out what people want. I think there's, one, I think you always take the evidence of what you see people do, right? So I think for us, like one of the early signals that people were interested in treasuries was a massive increase in people buying treasury-based ETFs, right? So I mean, like, believe what people do more than what they say, but of course we spend a lot of time talking to our members, and then also just applying like our good and our team and our leadership team's intuition about what is interesting based on what what would be interesting for our customers based on what we know about their needs. And so I wish I could say it was just like one particular thing at any given time, but it's not. It's always a mix all the time of listening to customers and seeing what they do.
Yeah. Actually, let's go back a little bit when I asked you a little bit about your customer base. Can you talk a little bit about what's different, sort of the demographics of that investor base in particular?
Yeah, I mean, I think we started the company or launched the company about 4 years ago, right? And so I think if you take late 2019 to today, I think we started in a place where, it was a more limited offering than what I've described recently, right? It was very focused on literally just like stocks and ETFs and building the context I described earlier. And one of the critical points of that context was building a great community around investing. That's a through line that still exists today and is one of the ways that, our members really get the most out of the public platform and really build their understanding of the markets. And so as a result of that, I think over time, we've been able to build a more diverse set of investors that, don't necessarily match what you might expect from a classic retail investment platform. So I think we've, certainly more gender diversity and certainly more socioeconomic diversity than I think you might expect in a platform of our size. And I think anyone that, we should all put that within the context of retail investing, and especially sort of our version of self-directed investing, is naturally like a disposable income product, right? It's an after-tax investment account. So again, great financial advice for the vast majority of people is, hey, allocate capital, allocate your money to your tax-advantaged accounts first, and then before you start, looking at after-tax accounts. I think this is all sort of like well understood. And so I think as you look at the customer that we appeal to, it's certainly still a median and above sort of income population, but probably mass market within that. And I think, it's always going to sort of, fall in there. And I think we've been really pleased with the, breadth and diversity of the clientele we've been able to serve over the last few years.
Interesting. And so at Andra, we're a late-stage growth tech company. So selfishly, the question is, how do we or other alternative investment managers or private investment platforms, how do we tap into what you've managed to basically build and innovate?
It's a good question. I mean, I think, I have both like the pithy answer, which is like, I think bringing alts to a retail investment platform or to a retail investment population is hard, right? And it depends on what you mean by alts, right? I think we've seen a lot of success recently in cash flowing assets and finding ways that you can do that without sort of an accreditation hurdle. I think that accreditation hurdle is always going to be a challenge, not so much because there aren't a lot of accredited investors, but actually because if you're going to publicly market it, you have to positively verify their accreditation, which is an interesting challenge because it just adds friction. And I think, at the end of the day, we're sort of consumer software people, and anytime you run sort of any kind of user interface or user experience, every little bit of friction that you put in the process is going to reduce your conversion. And it's and putting something as big as a positively verified accreditation hurdle in front of anyone, it's going to cut your conversion probably by 2/3, right? So even if you start with a population of Americans that are pretty well, where you've got a large population of people that could be accredited, actually convincing any substantial portion of that to follow through on, one, opening a brokerage account, two, funding a brokerage account, so linking their bank and dealing with all their bank details, three, going through a positive verification flow, so uploading a W-2 or any of their tax, any prior year's tax information, a letter from an attorney, a letter from a CPA, right? Like those are the four dominant ways. Any of those things, like all of a sudden you're just like slicing the apple really thin to be able to get like any variety of uptake. So it's just like becomes a fundamental software and conversion problem at that point, which I don't know. I don't have a ton of hope. I mean, I think there is, interestingly, I spend part of my time dealing with DC related matters. And there are a few interesting proposals being floated in Congress about sort of democratizing access to these accredited products. And I think those sorts of things where you can either have a test or or we reduce some of the barriers, I think will help us drive more adoption in those categories. But in the meantime, I think the best that we can do are find the sort of novel ways to bring alts to the public, to the public markets that don't require that sort of affirmative accreditation.
Yeah. And maybe we start with things that are a little bit less high octane and maybe safer, more back to the fixed income side credit.
that's where we're seeing the demand today. I mean, I think in different, it's the right product for the right market cycle, right? I think if we were having this conversation 3 years ago, it'd be like, hey, how can you give me access to like the highest, like the most speculative growth VC funds, right?
Yeah.
Like literally, if we'd have launched
Yeah.
an alt product 4 years ago and asked customers what they wanted, they would have all wanted allocations to Tiger Global,
Yep.
right? And like investor. And like that's what we would have seen from that part of the cycle. I think this part of the cycle is different. And I think, you know, as a business manager trying to like figure out where you are in the cycle and make bets sort of 6, 12, 18 months ahead is just part of the challenge of our business, but that's the game we're in.
Got it. All right, so I'm going to ask you, I know we have like 2 minutes left, so let's just big macro view. Where do you see the market going in the future? Like, just fast forward, so for folks that are trying to build the next public, where should they be thinking and looking?
I mean, hopefully the markets are going up and to the right. I think that's good for all of our businesses, and many of us run venture-backed businesses. That's even more important for that business. But no, I mean, I think again, my expectation generally is that, you know, if we look, and I'm like going to wax macroeconomic right now, which is not at all my expertise, but I think if we looked at the last 15 years of the macroeconomic cycle, that's sort of more the anomaly than what we're seeing today. And I think we should all be prepared for a rate environment that is higher for longer. I mean, I think that's what we're hearing from our policymakers and from the Fed. And I think, you know, I think at some point we probably do see rates fall, but I don't know that we ever get back to the ZIRP world. And so I think finding businesses that can succeed where, you know, sort of the reference policy rate's going to be in the 2 to 5%, 2 to 6% range, is, you know, what we all want to see and where we are. And I think for retail investors, I think the thing we're thinking a lot about is actually if we're not going to get all the way back down to zero, but there probably will be a back end of this curve. Mm-hmm. And therefore, how do retail investor behaviors change as we go from a reference rate of, you know, 5.25 to 5.5 all the way down to, again, something that's matching the current inflation prints in the 2s and 3s? Yeah. And how do retail investor expectations change that? So I would just, you know, that's, I think, where our head and minds are at, is how do we make sure as a business we're prepared for sort of whatever way that rate curve changes.
Got it. Great. All right, I think we're out of time. Thank you very much, everyone, for your attention. Thank you so much, Stephen.
Thanks for having me.